This is illustration 3 from Comprehensive Illustrations section. On 1st January 2021, Sam Company Limited agreed to purchase 20,000 US dollars from JT Bank in future on 31st of December 2021. All right, so the term or maturity period was actually 12 months where Sam Company has agreed to purchase $20,000 at a rate equal to 68 per dollar. All right, so I have contracted to purchase or to receive $20,000 and I have agreed to pay 68 per dollar on 31st of December 2021. Sam Company did not pay any amount upon entering into the contract. All right, so the initial investment is actually equal to zero. Sam Company is a listed company in India and prepares its financials on a quarterly basis. All right, so probably there are going to be three balance sheets that I will have to prepare before the settlement date. I have to prepare 31st of March, 30th of June, and 30th of September. I have to prepare balance sheets for these three dates on each of these three dates, I will reflect this forward contract at its fair value. I will be reflecting this forward contract at its fair value. If the fair value is positive, that will be a financial asset. If the fair value is negative, it's going to be a financial liability. Following the principles of recognition and measurement as laid down in Ind AS 109, you are required to record the entries for each quarter end till the date of actual purchase of US dollars. On 31st of December, you're actually going to purchase the US dollars. Until then, they're asking you to show the journal entries. For the purposes of accounting, please use the following information representing mark-to-market fair value of the forward contracts as at each reporting date. They've given us the fair value of the forward contract on each reporting date. On 31st of March 2021, there is a negative fair value of 25,000. Now, if you think of it, I have agreed to purchase $1 at rupees 68. I've agreed to purchase $1 at rupees 68. This is the contract that I've entered into on 1st January, but the agreement to purchase is on 31st of December. I will purchase it on 31st of December. 3 months have passed by from 1st Jan to 31st of March. 3 months have passed by. Let us say the rupee per dollar has actually fallen. Let's say the rupee per dollar has actually fallen down to 65. If you think of it, I have agreed to purchase it at 68, but in the market it's actually available at 65, which basically means that I am actually having a loss. I'm having a loss because I'm paying 3 rupees extra per dollar, and therefore I actually have a negative fair value. I'm actually sitting on a loss, which means that I have actually got a negative fair value. Negative fair value basically means it is a derivative financial liability because I am actually receiving a dollar or I'm purchasing a dollar under unfavorable conditions. I'm purchasing it under unfavorable conditions because in the market it's available at 65, but I'm actually agreeing to purchase it at 68. So what would be the journal entry for this? The journal entry for this on 31st of March will actually be P&L debit to derivative financial liability. I'm writing to DFL, which is derivative financial liability of 25,000. All right, we have recorded a derivative financial liability of 25,000, and correspondingly, the debit is basically to the P&L account. All right, we correspondingly debit the P&L account because all gains and losses on derivatives are going to be recognized in P&L. As at 30th of June 2021, the fair value is now equal to negative 15,000. The fair value is actually now equal to negative 15,000. Now, what we are going to do is we already in our books of accounts have a derivative financial liability of 25,000. We already have a derivative financial liability of 25,000. What the question is saying is that derivative financial liability should now come down from 25,000 to 15,000 only because I actually have a lesser amount of loss. On 30th of June, my loss amount has actually reduced. On a cumulative basis, I only have a loss of negative 15,000. So I need to have a derivative financial liability in my books of accounts of only 15,000. Therefore, my liability, which is in the books at 25,000, should reduce by 10,000. It should reduce by 10,000 to 15,000. To reduce a liability, what we would be doing is on 30th June, I am basically going to debit derivative financial liability by 10,000 and I will credit P&L by 10,000 again. All right, so I'm going to credit P&L by 10,000. So the first journal was on 31st of March where I actually debit P&L by 25,000 with a corresponding credit to derivative financial liability. On 30th June, I debit derivative financial liability by 10,000 and I credit P&L. And the reason I'm doing this is on a net basis, I now only need a derivative financial liability of 15,000. The question mentioned that the debt net liability should only be 15,000 as at 30th of June. Therefore, I'm reducing my derivative financial liability. Let's think for a minute. Why did my loss actually reduce? Why did my loss be 25,000 on 30th of March and why did it reduce only to 15,000? Probably between 31st of March and 30th of June, let us say that dollar actually, let's say, increased from 65 to let's say 65.5. I'm hypothetically just making some numbers up. Earlier, I said that the dollar value fell down to 65, therefore I had a loss. In this period, let's say it marginally increased. It increased from 65 to 65.5. Now, if you think of it, are we at a loss? The answer is yes, because I am contractually obligated to purchase at 68. The dollar value is 65.5. Therefore, I'm still at a loss, but I'm better off compared to 31st of March. On 31st of March, I had a higher loss because the dollar value was 65. Now I'm slightly better off, but I'm still at a loss. All right, so I'm slightly better off compared to March, but I am still at a loss, and therefore the liability is still negative. All right, therefore the value is still, fair value is still negative, and therefore I'm recording a liability in the books of accounts. As of 30th of September, the fair value has now become positive and the amount is 12,000. Now what we are saying is I should actually have a fair value asset or a financial asset in my balance sheet of 12,000. I am supposed to actually have a financial asset on the balance sheet of 12,000 because the fair value is now positive. Now, why did it turn positive? Probably the value of this dollar increased to 70. All right. So I am now required to pay only 68, but in the market, the value of the dollar has increased to 70. So I am at a gain. Because of that gain, the fair value is probably positive, which needs to be reflected as a financial asset in the books. All right. So what we are going to do is we have to now create a derivative financial asset, and the value of such asset should actually be equal to 10,000. All right. Or was it 12,000? Sorry. Yes, it was 12,000. So I need to create a derivative financial asset of 12,000. In the books, I already have a derivative financial liability of 15,000. All right. So since I have a liability already, I need to reverse that liability out as well. So I debit derivative financial liability by 15,000 rupees and I credit P&L by 27,000. If you look at it, actually the gain that I made during this period, I went from a loss of 15 to a gain of 12,000. So the total gain that I made during this period is 27,000. All right, I was sitting on a loss of 15,000, but I went to a profit of 12,000. So the total gain in the quarter is 27,000, which is what we actually have over here as well. So on 30th of September, the fair value of the derivative contract is a positive value of 12,000. Therefore, I debit derivative financial asset by 12,000. I earlier had a liability which is no longer required, so I debit derivative financial liability of 15,000, and the credit will basically go to P&L of 27,000. Another way of calculating this 27,000 is basically if you look at it as at 30th of June, I had a loss of 15,000, but as at 30th of September, I went to a profit of 12,000, which means for the quarter, I made a profit of 27,000. How did I make a profit? Probably the dollar value went up from 65.5 to 70, and therefore I am actually making a profit. Making a profit because I contracted myself to purchase it at 68, whereas and now the market price is 70. Therefore, I'm probably sitting on a gain. Finally, on 31st of December 2021, the spot rate is actually 66 per dollar. The spot rate of US dollar is 66. Now, if you think of it, finally, this position has ended at a loss because I contracted myself to pay rupees 68 per dollar. But over here, the spot rate is 66, which means I'm paying 2 rupees extra per dollar. I'm actually paying 2 rupees extra for every dollar. 2 rupees extra for every dollar multiplied by $20,000. If you think of it, I'm paying 2 rupees extra and I'm purchasing $20,000. So the total loss that I'm actually going to have is 40,000. The total loss that I'm actually going to have is 40,000. Therefore, the fair value of the forward contract on 31st of December is 40,000 negative. This is basically a loss. Remember, this is a loss because I am contracted to pay 68, but in the market it's available at 66. Therefore, I am actually having a loss of 40,000. If you're confused, let us actually come back to the example that we were doing over here. How did I calculate the loss that I had? I actually compared the forward price with the market price, right? I compared the forward price, which was 1800, with the market price of 1600, and I arrived at a derivative financial liability or a loss of 200 rupees. I was contracted to pay 1800, but the market price is 1600. Therefore, I am supposed to actually create a derivative financial liability, is what I said. Now, applying the same principles over here, I am buying something at 68, but the market price is 66. Therefore, I'm making a loss of 2 multiplied by $20,000, which is equal to 40,000 of loss. All right. So the fair value of this derivative contract on 31st of December is a negative 40,000. Now, therefore, in my books, I need to actually have a derivative financial liability of 40,000. I am supposed to end up with a derivative financial liability of 40,000. If you think of it, I now have actually a financial asset of 12,000. I'm actually sitting with a financial asset of 12,000, but I need a derivative financial liability of 40,000. So the journal entry for it will be I will debit P&L. I will debit P&L. If you think of it, I was at a profit of 12,000. From a profit of 12,000, I came down to a loss of 40,000, which means for the quarter four, I made a loss of 52,000. I was sitting on a profit of 12,000 and I made a loss of 40,000. Therefore, I'm sitting on a loss of 52,000 for the quarter. Therefore, I debit P&L by 52,000. I credit the financial asset. We actually had a derivative financial asset. So I'm crediting the financial asset, which is no longer relevant by 12,000. And I again credit derivative financial liability by 40,000. I'm supposed to have a 40,000 derivative financial liability in my books of accounts. All right. Why am I supposed to have a 40,000 derivative financial liability? Because my total loss is actually 40,000. All right. My total loss as a date is 40,000. Therefore, my books are supposed to reflect a derivative financial liability of 40,000 rupees. And for the quarter, I made a loss of 52,000. Now, on the same date, on 31st of December, I will actually also settle the transaction. I am also going to settle the transaction by actually purchasing US dollars. I'm going to purchase US dollars and actually settle the transaction as well. Now I'm actually recording it. Let's say I am going to receive cash in dollar terms. I'm going to receive cash in dollar terms and I debit that. I'm going to receive $20,000. Although I'm paying 68, I am not going to record it at 68. I will be recording it at its fair value, which is actually equal to 66. I'm going to record it at fair value, which is actually equal to 66. And this is going to be 13 lakh 20,000. All right, this will be 13 lakh 20,000. I am actually going to pay cash in rupee terms. I will be paying cash in rupee terms, and the amount that I'm going to pay is 20,000 multiplied by 68. I'm going to pay 20,000 multiplied by 68, which is equal to 13 lakh 60,000. If you actually look at it, I received cash in dollar terms whose value is 13 lakh 20,000, but I actually paid 13 lakh 60,000 rupees, and the remaining debit is going to go to derivative financial liability of 40,000, which is what I actually created over here. All right, what I created as a financial liability will get debited over here, and I will credit cash of 13 lakh 60,000. It's exactly the same as what we followed earlier. Over here also, I debited the derivative financial liability of 200 and recorded the investment in Reliance shares at its fair value, over here as well, I am going to record the cash that I received in dollars at its fair value, and then I will actually debit the derivative financial liability and credit the actual cash outflow. All right. So this is how we are actually going to record the transaction. All right. This is going to be regarded as a derivative, and every derivative is required to be measured at fair value, with gains and losses being measured via P&L. And on each balance sheet date, we have to reflect the derivative at its fair value. On 31st of March, the fair value was negative 25,000. So the journal entry was P&L debit 25,000, credit derivative financial liability of 25,000. On 30th of June, the financial liability, which was earlier 25,000, is now reduced to 15,000. So therefore, I need to reduce my financial liability, and hence I debited the financial liability and credited my P&L. In the third quarter, I actually was sitting on a profit of 12,000. So I actually had to fully zero out my liability, and I had to create a fresh asset of 12,000. Therefore, I debited derivative financial asset by 12,000. To zero out my existing financial liability, I debited it by 15,000 because I had a 15,000 derivative financial liability. So I debited it by 15, and the credit was 27,000 to P&L. Now, on 31st of December, the question did not give me the fair value of the forward contract, but we can actually calculate the fair value of the forward contract on 31st of December by actually comparing the forward price with the market price. Forward price was 68, market price is 66. Therefore, I am actually sitting on a loss of 2 rupees, and therefore, I am actually required to record a derivative financial liability. How much liability are we supposed to record? I am supposed to record a liability of 40,000, because over here I have a contract to actually purchase US dollars under unfavorable conditions. Unfavorable condition is basically to the tune of 40,000. I'm purchasing a dollar at 68, but its value is only 66. Therefore, that is basically the unfavorable condition for me, and I have to record a derivative financial liability of 40,000. But in my books of accounts, I was actually sitting on a derivative financial asset of 12,000. So first I need to make that asset out as zero. I need to make the nullify that asset by crediting the asset by 12,000. I also need to credit a separate financial liability of 40,000, and therefore the debit to the P&L account will actually be 52,000. All right, because in the quarter I made a loss of 52,000. So that way we are actually going to record the journal entries. All right, let's take a quick look at the institute solution. So accounting on 1st of January, there's going to be no journal entry because there's no consideration paid. 1st January was the date on which I entered into the transaction, and we saw that there's going to be no journal entry on that date. Next is accounting on 31st of March. We have P&L debit to derivative financial liability. On 30th of June, we have derivative financial liability of 10,000 and credit P&L because the derivative financial liability became a loss of only 15,000. Earlier, I had a loss of 25,000, but now that loss reduced to 15,000. Therefore, I'm actually debiting my derivative financial liability by 10,000. On 30th September, I reverse out the entire liability. I reverse out the entire liability, record a new asset of 12,000 and record a P&L of 27,000. On 31st of December, I actually posted two journal entries, but over here they actually posted a net journal entry. All right, they've posted a net journal entry, but the impact is going to be the same. You debit P&L by 52,000, which is also what I did. If you recall over here, I also debited P&L by 52,000, just that they've combined the journal entry. All right, so it's going to be bank account debit. You record the US dollars received at the fair value of 66, but the credit outflow is actually 20,000 multiplied by 68, and you record a P&L item, P&L loss of 52,000, and you're crediting the financial asset which is existing in the books of accounts. All right, this is the combined journal entry. So that is how you actually account for forward contracts. All right.